In this particular segment, we want to dive into our grain trade and welcome along a little extra help from Brian Hoops. And he is the president of Midwest Market Solutions in Springfield, Missouri. Lots of dynamics at work today, but largely outside of the U.S. borders. Brian, we have had a rally going on in much of the grain complex today, if not all of it, except for cotton. Let's take a look at our prices on the corn market here right now. On the big board, the quotes provided by bar charts showed nearby March a dime higher now at 6.64 1/4, and December is up 2 3/4, just barely above $6 at $6.50, at least for the moment. Now, moving on to soybeans, we have the nearby March contract actually gaining 20 cents again, and we're at 16.21 per bushel. Big time surge there. Nearbys are leading the way higher on the soybeans. If you go out to new crop November, it's only 4.5 cents higher at 14.68 1/4. So they're widening that spread out almost 16 cents right now. Now, if you look at our wheat market currently in Chicago wheat, you now have that nearby March contract trading 13 1/4 higher. It's at 8.10 1/4 here this morning. July is up 14 cents. In Kansas City wheat, March up 17 3/4 at 8.53, July up 17 1/4. And in the spring wheat market now, you have the March trading 7 higher. We're at 9.67 3/4, while July is now 9 1/4 higher. The far out deferreds are 10 and 11 higher for September and December. So, Brian, a lot of this market action here this morning, from what I understand, it sounds like nervousness over maybe a disruption of exports out of the Baltic Sea region, maybe around Ukraine and Russia. But, I mean, come on, what's an incursion between friends, right?
Yeah, right. Good morning, Marlon. Yeah, those are the things that we're really focusing on, talking with clients about, is what's happening between the Ukraine and Russia, and any sanctions that may be placed on Russia because of what is happening overseas. That's one of the major factors driving crude oil prices. It's affecting corn and wheat and some of these other markets as well. But there's also a change in the forecast to South America. Argentina looks to have their best rains since back in October over the next couple weeks, and that could take a little bit of the top end off of the soybeans. Now, last week their crop ratings did improve quite a bit, up to about 31 good to excellent. So that's it's an improvement, but it's still a very poorly rated crop. Corn was downgraded a week ago to a little bit less than 19% good to excellent. So not very highly rated crops, but with the rains coming in, that could limit some of the advance. At least it's a change in the forecast, and it should allow more harvest activity in northern Brazil, where they've been really flooded and just can't get the crop out of the ground. They should be able to get some harvesting being done. So those are the things we're really talking about with our clients today as we go into the trading session. Is, yes, we're making contract highs, but there are these fundamentals factors that at work, and that could be a little bit of a change to the soy complex.
So is that why we're seeing such a spread change in the soybean trade? Like you mentioned, you have the nearby March. Right now we're about 19 cents higher. But also we mentioned that you have the November only about 4.5 cents higher on the day. That's a big spread change in one day. How can our producers capitalize on that to take advantage of that? What do you recommend?
Yeah, a lot of producers that we talk with are asking us, what can we do to lock in these prices? November beans at $14.67. That's over $14 in many, many areas. Same thing with corn. We're knocking on the door. December corn is $6 this morning. How do we lock that in and keep from letting it slip away? Well, the first answer is probably using some option strategies. Some put options would be the simplest strategy you can use, and that protects your downside, allows for additional upside potential. Those options are very expensive at this time of year when you're buying that much time out there. So if you can hold off and wait to buy them, maybe closer to the acreage report or when we're planting, they will be a little bit cheaper. But that's probably the easiest, simplest thing to do, is to talk about that. Otherwise, you can look at locking in these price levels, these cash sales, and it's hard to go wrong if you're locking in $6 corn, $14 soybeans.
And a quick look at the crude oil trade. We've been watching that all morning, had about a $6 range overnight. We're still hovering around the middle of that range. March West Texas crude now at $92.88 per barrel. That's up $1.81. Brian, we'll take a look at livestock right after a quick break. We'll have more with Brian Hoops. Well, let's go back to our conversation with Brian Hoops, the president of Midwest Market Solutions. And Brian, as we take a look at the livestock side, you can't help but wonder, with all the talk about the trucker strike in Canada expanding now maybe into the U.S. and lots of talk about multiple routes possibly being planned across the U.S. And you can't help but wonder if that would have an overall impact on the movement, transportation of cattle, hogs, meat, beef, pork across the country here. What kind of dynamic would that have on the overall, well, the cash, cattle, and hog trade and the retail market here?
Yeah, especially if it's from a cold storage facility into some sort of a grocer, it would certainly prices taking supply away from the marketplace, and when there's a time when there's decent demand for beef and pork products, so it would raise prices. It's that would be a direct impact on the market. Cattle futures giving up a lot of their gains here this morning. The stock market's starting to weaken. I think that's kind of pulling the cattle down along with it. Plus, you have higher corn prices that are limiting the effect. You have a cattle and feed report coming out Friday afternoon. The early estimates I've seen looking at on-feed supplies expect to be near record levels for this time of year, just a little bit larger than last year's numbers.
So the live cattle right now, you have your February contract 20 cents higher. We're at 143.45, and April is down a dime. Everything had been a little higher earlier. Right now we're at 145.80. The deferred contracts, 2 or 3 ticks lower at this moment in time. October down 15 cents. But if you get to the feeder cattle market here, you have triple-digit losses across the board. And the March is down $1.35. April down 145 at 169.40. That's pretty steep losses across the board. What are they afraid of?
Yeah, we're fearful that the demand's going to start to wane for some of these feeder cattle, especially as corn prices continue to march higher. We were just talking in the segment ago about corn being $6 on the new crop. It's hard to feed corn prices that high to these cattle. I think if you can put them on grass for a while, there's demand for that. But putting them on feed and feeding them out for 6 to 9 months at $6 corn, it can be a very expensive proposition. So there's, I think, demand starting to back off. Surprisingly, it's held on very strong through this time frame, but it may be showing signs of weakening here along with the economy.
Well, the April currently now just ticked down to $1.52 lower. Lean hogs, though, the April up $1.17 at 110.57. That's about 75 cents or 70 cents or so off of our earlier high of the day when it got up as high as 111.25, which would mean more new contract highs. Most of the contracts on the lean hogs are over $1 higher. Phenomenal trade in that hog market. Brian, thanks for the information today. Appreciate it very much. Brian Hoops of Midwest Market Solutions. Tammy, that's the very latest on the markets.